So I've closed over $1 billion in hard money loans, and I can assure you one thing. Not every project qualifies for hard money. In this video, we're going to talk about qualifying factors, disqualifying factors, and really break down what it takes for you and your project to qualify for a hard money loan program from a lender like me. So one of the first things that I want to bring up about hard money lending and qualifying for a hard money loan from a lender like me is that there are lenders of all different shapes and sizes. There's lawyers, doctors, dentists that will lend their money to local builders and flippers, and that's been money that's been around as long as gambling and prostitution, is like to say. It's literally the oldest form of lending. So what we're going to cover here is more of what I would say the average, hard money lender, and I really want to continue to refer to it as a bridge loan. A hard money loan is just a short-term bridge loan. In my opinion, it's made by a private lender. And the fact of the matter is you can find friends and family money all the way up to, a $3 or $4 billion private lending company that can make loans of all different types. It could be 5+, it could be 1 to 4s, and lenders have their different criteria and their different credit standards. And so what we're going to focus on here is, I would say, the middle to upper tier of the private lending spectrum. We'll say that you have the world of the expensive banks, is what I like to call them, the really large private lenders that require a little bit more paperwork. And then on the other side of the spectrum, you have your, again, lawyers, doctors, dentists who can close loans in 3 days. We're going to talk about this part of the spectrum. We're going to talk about lenders like me who have the ability to step in and do deals quickly. I close loans in 3 days, but my average loan might close in 10 days. And that's something that when you're working with a group like ABL or you're working with somebody like me, we're going to be hands-on like a local lender, but try to get through and expedite the process faster than a national lender. So the one thing we're going to start with right out of the gate is disqualifying factors. And when you look at a loan, from my perspective, there aren't very many disqualifying factors. I mean, certainly programs are geared towards certain property types, but at the end of the day, the biggest DQ factor that I deal with is just, as a private lender, as a hard money lender, I can't fund owner occupants. I can't close a loan on your primary residence. I am able to offer programs that can close quickly without all of the paperwork, simply because I'm a private lender and I'm lending to an investor. And in fact, as a private lender, as a hard money lender, I'm going to make every investor form an LLC, and that LLC becomes our borrower. And we'll even make you sign an affidavit at closing saying that you're not going to occupy the property. So one of the big things that I want you to keep in mind, first and foremost, above anything else, is that if you're looking to come to me or to go to a hard money lender to fund a house that you live in, it's not for us. We're not going to jeopardize our ability to continue making loans to investors by crossing that line and lending to a consumer and bringing on all of the consumer protection laws and regulations that really we're trying to avoid, because we're the anti-bank. We want to make loans quickly. We want to facilitate transactions. And if we start to come, in my opinion, further down the spectrum towards a bank, well, then we're no longer a private lender doing what we do best, which is, in my mind, the speed of money. So at that, we're going to get into qualifying factors. So one of the most important factors in screening projects for me is to quickly understand a couple things. I want to understand what the time frame is of the project. I want to understand whether the borrower can execute said strategy within the term of the loan. Most hard money loans are going to be anywhere from 6 months to, say, 18 months, with the average being, I'd say, right around 12 months, right? So do you want to get into a loan that's 6 months in length or even 12 months in length if you're going to be renovating a property over 18 months? Of course not. You're putting yourself into a situation where you have to finance a project twice before you can get the full strategy and the time frame covered. The fact of the matter is you want to make sure that you're doing a deal, a project that fits the time frame. And a perfect example is a fix and flip. We're offering 12-month loans here at ABL. A fix and flip, I'd say on average, if you look at our portfolio, the average fix and flip is, in and out between, say, month 7 and month 9, month 10 maybe. A fix and flip is a natural fit for a hard money loan program. Same with ground up construction. Same with multifamily properties that are looking for a quick purchase, rehab, restabilization of the tenant profile, and then move to then eventually refinance. The speed of the deal, I think, is the first thing that I look at to make sure it fits. The borrower can execute the strategy within the time frame. The last thing I'd want to do is put a borrower in a short-term loan, and the deal really fits more for a long-term loan. That's one of the most important things that you should focus on for sure. The second thing I'd say is, does the profile of the deal meet the profile of the borrower's experience? So if you're coming to me and you're looking to a fix and flip, and it's a, let's call it $100,000 rehab even, you don't need any experience. I'll do a first-time flipper all day long as it's a cosmetic rehab. But if you're looking to finance addition or a heavy rehab, a gut rehab, and you haven't done it before, in this world that we're in with the volatility in construction, prices are very difficult to nail down. Never mind timeframes in construction and all that goes into that. It's very likely that a first-time flipper would be into a deal for far more than they expect it to be through cost overruns, et cetera. So at the end of the day, we want your experience to match the deal, the strategy, and make sure that you can execute. And we're going to count the experience. So once you have experience, for the most part, as long as the economics of the deal make sense, we're going to fund it. And we'll get into borrower conditions in a second. But the fact of the matter is, experience is paramount. Your ability to execute the strategy and to be able to show on paper that you've done it over and over again is going to get your deal approved, and then it's going to work your rate down and your leverage up over time as you get more experience, because it makes sense, right? We're common sense lenders. We see less risk in making a loan to an experienced borrower, right? So the borrower with more experience is going to get better rates, better terms, more leverage. We're willing to take on more leverage against that same property value with an experienced investor, simply because there's a lower probability that investor will have a problem getting through the renovation or executing the strategy and either refining or selling the property to repay our loan, again, within the 12-month period. Experience, it means everything to us. With regards to borrower, let's call it conditions outside of experience, generally we're going to have a minimum credit floor. It's typically around 660. I've done loans with borrowers that had 590 credit because their experience was so good in executing the strategy, and we saw that it was a temporary issue. So we looked at credit. We didn't even blink on the deal. The loan was approved in 24 hours because the experience was there, and we saw that it was a short-term issue. So there's benefits there with flexibility. We'll make sure the borrower has liquidity. We want to make sure the borrower can put the money down, and then make sure the borrower has a little bit of extra working capital to make loan payments, buy materials, to install and be reimbursed through construction draws. And then in that context, it's a perfect segue, because I think what I find is the absolute best deals for hard money are transitional value add plays. You're coming in, you're looking to take the value from A to B. Otherwise, there's no reason to get into interim financing. I mean, sure, you might need to purchase it quickly, but our bridge loans, our hard money loans, are really meant to take a property's value from A to B. It's the perfect, 1-2 punch with our DSCR program to finance the BRRRR strategy, right? So as an example, I turned down a deal today. The borrower was coming to me, he was buying a property in Philly. Purchase price was $150, and he was doing a $50,000 rehab, right? So, all right, so it's a value add, right? But the fact of the matter is, upon completion of the value add, the property was really only going to be worth $25,000 or $30,000 more than the investor was going to be into it for. There was no real upside in that. I took the borrower and I said, listen, this isn't really a fit for maybe more of a traditional hard money loan, that bridge loan. You're going to be finding yourself coming to the end of your bridge loan term with really no upside in value, which is ultimately going to mean that with no upside, you're going to find yourself in a position where you have to pay down the debt to refi out, or you're forced to sell. We want to make sure that there's a value add play. I think that's the best fit for a hard money loan program. Ground up construction, multifamily repositioning plays. It could be re-tenanting, a renovation. We talked about fix and flips. Those are the plays that work best. And we're going to look at the strategy much like you are. I've done over 100 BRRRRs. When you come to me, I'm going to look at the numbers closely, and I'm going to pick them apart, and we're going to do better case, downside scenarios to make sure that those exit strategies are protected. But ultimately, with that value add play, there's profitability that you'll realize either on sale or in the cash out refi, or in a rate and term where you have enough equity to get this hard money loan out within the 12-month period. Value value add plays, it's the void that the hard money space has filled since the financial crisis and will continue to fill. And you're seeing big names come into the private credit space because at the end of the day, when the banks are not lending, that's when groups like ABL, that's where hard money lenders really thrive, because we're coming in and we're filling that void. And usually they're distressed assets, much of the time bank owned, auction properties that allow us to kind of facilitate that transaction, give the borrower enough renovation money to get through it. We always fund 100% of the reno. And then at the end of the day, execute either refi or sale. And that value add, that appreciation of value keeps our loan at an LTV level that makes sense for us today, but ultimately on the exit and potentially and hopefully for the refi lender. So the best deals are the deals where everyone makes money. And no one wants to get into a loan program that doesn't match the strategy. And here, we're lucky. We have programs both long and short, both bridge and DSCR. And DSCR is the perfect complement to bridge. So when the deal isn't a value add play, it doesn't have a fast moving time frame, or for whatever reason it doesn't fit the bridge program, we can easily move it over to a DSCR program that perfectly complements the bridge program. It's investor only, like the bridge. Again, no owner occupants. But we're going to get you into a program that works for you. And you shouldn't be shy about reaching out to me with any questions. I'm on the phone all day long talking to borrowers, much like yourself, and I'm happy to help. And I'm going to continue to make videos that's going to go through all the different topics relating to hard money, DSCR loans. But, as always, please, like, comment if you have questions, subscribe. This video is sponsored by Asset-Based Lending, and feel free to reach out to me anytime at Mike Chadwick, JR for Junior. Thanks for watching.